Good afternoon, ladies and gentlemen, and welcome to the G4S Investor Relations Update. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available in your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand over to Helen Paris, Director of Investor Relations at G4S. Good afternoon, Helen.
Thank you very much. Welcome everyone, and sorry for the delay and some technical problems, which I guess we're all getting used to now, sort of majority of us working from home. So I'd just like to start. I'm going to just go through the slides. So I'm currently on slide 2. G4S is the world's leading security company, as you may know. We are in more than 84 countries. We have 535,000 employees, and that makes us by far the largest and the most broad in terms of the numbers of countries of operation. We were formed from the merger of Group4 and Securicor in 2004, and that's quite important really in terms of the history of the group and where we expect sort of going forward, and some of the changes that have taken place. We're primarily listed here on the London Stock Exchange, and we have a secondary listing in Denmark, which is basically a historical listing as a result of Group4 being a Danish company. Our strategy is to basically invest in the resources and capabilities to make sure that our customers have industry-leading solutions to make sure they can operate securely, reliably, and efficiently. So now going to move on to slide 3, which is really to go through our half-year results in a bit more detail. We have to, I'm afraid, put a legal disclaimer around forward-looking statements. You can read that in your own time. So if I start really on slide 6, one of the really important things that have happened to G4S so far this year was in February that we sold the majority of our cash business. So that's the blue G4S vans that you often see driving around, parked in the city and so on. And with the sale of that business, it really means that we are at a very important inflection point in terms of the group going forward. It means we can really focus on security, primarily now that's our main business line. And it means that we also have around £700 million worth of cash that came in as related to the transaction, and that means that we are obviously in a stronger position as we are in this uncertain world with the COVID-19 pandemic. But our strategy, therefore, we set out for our vision for 2025 following the sale of the businesses to Brinks, and our strategy is very simple. As I say, it's about continuing to be the world's leading integrated security company, to continue to be innovative, and to really try and differentiate our offering to customers through technology, our people, our values, and our customer relationships. Providing manned security, particularly in big developed markets like here in the UK or the US, can be quite hard to differentiate if it's just a manpower offering that we have. And that's why technology is increasingly a way that we differentiate our business versus our competitors. It also provides probably data and therefore greater security assurance for our customers. If I move on to the next slide, slide 7, this is the split of our business by geography. And you can see that by far the largest market for us is actually Americas. So although I think people based in the UK are very familiar with the G4S brand, not necessarily always for positive reasons, but certainly a very positive brand around the world. So 40% of our revenues are in North America and Latin America, primarily North America. 34% is Europe and the Middle East. That would include here in the UK, which would be about 15% of that 34. And then we have Africa 8%, Asia 13%, and then the remainder of our business that is cash solutions is 7%. And I'll go into a little bit more detail about each of those and the relative performance of those businesses in recent months in certainly quite extraordinary times. So this is the shape of the group looking forward, assuming that all of the businesses to Brinks have been sold. Actually, about 75% have completed, and around 25% will complete in the next few months. Majority will complete in the next few months, and that's because we were selling multiple businesses. When you sell a cash business, you have to do basically a stock check. So you have to do a sort of a cash check, as it were. So quite difficult to do in multiple countries at the same time, even more so obviously when there is a lockdown. And so I think an incredible credit to the business that we've managed to get 75% completed. But this breakdown assumes that all of the businesses have completed, and there's no reason to assume that that won't happen. So looking at the proportion of revenue and profit, you can see that although our retail technology business, this is the cash technology that we provide to customers like Walmart, is just 3% of sales, it's actually 7% of profits, and therefore showing it's a high margin, it's high growth, cash generative business. We'll come on to that. It's not really necessarily core, but clearly is providing value to the group today and has the potential to provide a lot of value in the future. In terms of the business, I've mentioned we are in, I think, 85 countries. We are very diversified in terms of our type of customer, so we have no real concentration across a particular sector. But we have very important expertise in key verticals like oil and gas, financials, utilities, where clearly security has important considerations. And we have, we think, a very important global blue chip client base, which is really, as we're trying to sell more technology, it's using that existing customer base that we're looking to upsell. I talked about trying to differentiate what we provide to customers through technology. And today, around nearly half, so 49% of our revenues have some element of technology with that solution to the customer. And that may be something as basic as recording information, data, incidents, and so on, through to a much more sophisticated access control system, security operations center, a lot of jargon, I'm afraid, in terms of the services we provide. But at the end of this presentation, you will see there is a link to a video, 3.5 minutes. Hopefully that can give you a much better idea of what we do than I can explain. And so if you do have the time, I definitely recommend that you spend some time looking at that. So if I move on to the next slide, slide 9, this is basically the shape of the group now going forward. And this is really one of the most important slides in the deck. It shows that majority of our business is now focused on security, and that our risk consulting and technology, this part of the business, are expected to grow at roughly double the traditional business, and at a margin that is roughly double the traditional managed security business. So you can see the margin is around 12% versus 6% for the rest of the group, and with a potential to grow 10 to 12% rather than 4 to 6% for the rest of the business. Our retail technology piece, as I say, this is the cash technology, has a margin today of already 13% and is expected to grow roughly 15% per annum, because it has very low market penetration today and definitely has significant cost saving and working capital benefits to our customers in that area. Conventional cash, as all of us here in the UK know, there has been a real sort of move, I suppose, to reduce cash usage as a way of reducing the spread of COVID-19. We do expect some of that volume to come back, as we've seen sort of hospitality sector, bars and pubs and restaurants and so on come back online. But clearly it's not going to be probably the same levels that it was before. What we think that creates opportunity, though, is for banks and retailers today that still do a lot of the cash handling themselves. We think it will create a catalyst for them to outsource some of that cash handling to companies like G4S. And that's the sort of thing we do today for companies like Santander Group, but there are many banks in the UK, so people like RBC, HSBC, Barclays, that still do those services today. And we think that, as I say, as it becomes a less important form of payment, that we will see some growth in that space, which is why net we see the business being roughly flat going forward. One of the reasons why we kept the UK cash business, that's the majority of the conventional cash business that we've kept, is because we have a pension deficit. As with many UK companies, we have a defined benefit pension liability that, if we were to sell the UK cash business, could crystallise basically quite a big payout. So we decided, I suppose for pragmatic reasons, it was best to keep that business, continue to pay pension deficit payments of around £50 million a year, and expect to therefore see that deficit removed in about 6 years' time. So it's roughly a 300 million deficit, 50 million a year in pension top-up payments to get that to zero. So move on to the next slide. Slide 10. This was a slide that we showed in March 2020, so just really, I suppose, before the pandemic hit in Europe, particularly in a big way. And our strategic priorities were around growth, continuing to drive growth, both in our core services, but also to accelerate growth in the more technology-related areas, to continue to get the benefit of those higher growth, higher margin areas in terms of the profit mix, but also continue to be more efficient. With the sale of the Brink's businesses to Brink's, it means that we have the opportunity to, I suppose, sort of right-size the organisation, be simpler, and therefore take out cost, and to deliver free cash flow. We have had to deal with a number of legacy issues over the last few years, and it looks like we're coming to the end of those, certainly of any scale. So we should be able to deliver free cash flow going forward. So that's basically after, after all of the one-offs that we've had to deal with in the past. And really, we showed this slide to say this was our priorities in March, and actually today they are the same. What COVID has done really is, I suppose, accelerate some of these areas, so particularly in terms of the cost-cutting program and in terms of the focus on free cash flow. So moved on to the next few slides. So on slide 12, this was a summary of our performance in the first 6 months of the year. So overall, our revenues were just down 1.5%. Really quite an incredible performance if you think about, what has happened around the world, and shows the essential nature of the services that we provide. Our security business basically was unchanged at 3.1 billion, and where we saw an increase in technology, in the integrated security proportion that grew 5%. And our cash business, a very small part of the group, but that declined 16.5%, and that's declined even more, I think, than over 30% in the second quarter. So clearly had a significant impact on the UK cash business, as you'd expect. At a PBITA level, our margin, because of the cost-saving measures we took in place, because of the strong growth in areas like North America that I'll come on to, our margin actually slightly increased in our security business, and that is despite what we estimate overall of around a 20 to 25 million net profit impact from the COVID-19. Cash, not surprisingly, with revenues down 16%, this is a fixed cost logistics business. Profits were down there more than 33%, and again, because of the impact on the UK cash business. But overall, I think a pretty resilient performance. We had a very strong cash flow improvement. Operating cash flow 364 versus 164 million the year before. Part of that was driven by we've taken advantage of tax deferral schemes from particularly US and UK governments as a way of obviously preserving liquidity at this time of uncertainty. But even adjusting for that, we've had a good, strong underlying performance. And I think that shows, one, the essential nature of the service that we provide to our customers, that they continue to pay us so that we provide it, but also the focus from the business on collecting cash. Our free cash flow was strongly positive. Majority of that is because of the Brinks proceeds, which came in the first 6 months of the year. As a result of some of the refinancing that we've done, the fact that some of our non-fully owned businesses didn't perform as well as some of the ones that we own fully, actually EPS was unchanged. So again, a very resilient performance. Notwithstanding that, the board decided that they really needed to prioritise, the group's financial strength in the short term, and so decided to not propose an interim dividend. Clearly, we want to make the point that we recognise the importance of resuming the dividend as the uncertainty eases, and that is something that I think once we've got the level of uncertainty to seen as a manageable level, that dividends would be reinstated. On the next slide, slide 13, talking about the half-year growth, the split between the two businesses, really just to focus on some of the highlights. On the Secure Solutions side, I talked about revenues being unchanged. We actually saw strong growth in the Americas region, up 5.4%. In North America, it was more than 6%. And that was really strong demand in areas like for financials, healthcare, data centers, clearly areas that are much more resilient during the pandemic. Asia, I think, again, very resilient performance because of the essential service that we provide. We also have a care and justice business in Asia that would be less in Australia that would be less impacted by the lockdown. Europe and Middle East was the most adversely impacted in terms of our security regions, down 6.5%. And that's because although we do have just quite a small exposure to areas like aviation, leisure, events, they're about 6% of group sales altogether. They are very much weighted to Europe, particularly in case of events and leisure, and aviation is spread across the whole region. And so that was really where we saw the greatest impact. And unfortunately, areas like events, those are summer events, they're not going to happen. They're not going to come back. Wimbledon isn't going to happen in October, November. So that revenue is lost for this year. The Middle East starting to resolve, starting to come out of lockdown, but I think most expectation is that aviation volumes won't really pick up until next year. In terms of the cash solutions business, I've talked about the UK cash business. That's conventional cash business that we still own. In our retail technology business, this is where we basically recycle a lot of the cash in store back through into the cashier system. In some customers like Walmart saw a huge increase in the amount of cash that was being used during lockdown because of increases in areas like social security benefits. So in the US, there's still around 20% of the population that don't have bank accounts. They will basically be given a social security check, an unemployment check. We'll go into a Walmart store, we'll cash the check in store, and we'll then use that to purchase groceries. So actually a significant amount of cash usage. It's kind of counterintuitive to us sat here in the UK, but we dealt with large increases in cash in the US in the first half. And we also have a number of new contracts that we've won that because of that increase in I suppose in people going into grocery stores, we've seen those orders going to be mobilized in the second half of this year or into next year. Basically, it can be quite disruptive operationally, and so we've got a large backlog that we will deal with in the second half of the year, but very confident of that sort of customer proposition. In terms of the profitability and free cash flow, I talked about we saw an increase in the amount of revenues and profits coming from our technology business. That's helpful to the margin. We've also took the decision to try and take out 100 million of direct and indirect cost savings. So you might remember that slide I put up from March talked about 20 million, and we've added another 80 million. Some of those costs are related to activity. So if we see activity pick up, then you'll see the costs increase. So areas like fuel, travel, uniforms and so on. But if we don't see that activity, then those costs won't come back. So I think we're pretty well hedged, and therefore, as a result of that, pretty confident in terms of market expectations for the full year sort of profits, which would be similar sort of performance to the first half of the year based on consensus, which is available on the website. In terms of the free cash flow, I say an underlying improvement. In terms of the institutional investors that I speak to, I'd say this is their main area of focus at the moment. They understand the strategy. They're very pleased that we've got this very resilient performance, but they want to see the group continue to generate cash and continue to deleverage. Historically, for the last 5 or 6 years, we've been dealing with so many legacy issues. On average, we've paid out about £100 million a year on those legacy issues, and those we believe are significantly coming to an end. We don't see anything of the scale of, for example, the most recent one, which was a settlement with a serious fraud office, which was for around £50 million. I mentioned that we now have an alignment to executive pay. So free cash flow is now is one of the KPIs within the bonus and long-term incentive program. It wasn't before, it was operating cash flow. So I think that's a signal as well that we believe this is something that is achievable and continue, as I say, to reduce leverage and to resume dividends. The next few slides are after, say, we're going to, really, I suppose the main points are that this is, we believe now, a much more focused secure solutions business. If we think back to when Ashley Almanza, our Chief Executive, took over as CEO in 2013, at that point, I think we were in more than 130 countries. We had multiple businesses that were not really anything to do with security. We had locksmith business, we had car parking businesses, we had meter reading businesses, and we believe we are a much more focused business, both in terms of geographies and in terms of services. That gives us the ability to therefore grow in the areas that we want to grow and focus on, such as integrated security, and that has the added benefit for customers as well as growth and profitability. We have a market-leading cash technology business. I think long-term we are unlikely to be owners of that business, so potential for that to generate significant value for the group in the future, continuing to focus on productivity and free cash flow. So then the next few slides, the financial review, I'm going to really sort of just go through very quickly. So slide 17 talks about our underlying results. If you look at slide 18, I think this is quite interesting. It's looking at the monthly revenue growth performance. This isn't information that we would normally provide, but we felt during the COVID-19 situation that this would be helpful to provide more information and more regular updates. And so what you can see is that, in general terms, the pandemic impact peaked in April and May and across the group. And although obviously nobody can call out the path of the pandemic in the second half of this year, it definitely looks like revenue trends were improving towards the end of the quarter. And there's nothing that would make us think that will change. And again, I think that's because of the essential nature of the services that we provide. In terms of slide 19, as I said, we started with our sort of underlying results as our continuing business. And then what we show are basically the bridge between our underlying results and our statutory results. The main items there are the onerous contracts. So we have now a very small group of contracts that are loss-making. As you can see, in the first half, they just had revenue of £12 million, so very small. Historically, these were more material. And with the ending of the contract called Compass that provided asylum seeker accommodation last year, we have basically materially reduced this onerous contract portfolio. We have around £22 million pounds of provision remaining, but that provision is out to 2038. So you can see we lose very small amounts of money each year out to 2038, but the accounting requires us to recognise all of that loss and provide for it. We also continue, as I say, post the sale of the cash businesses to Brinks, we are continuing to restructure. That results in redundancy and costs, and so we split out what we would see as sort of strategic costs and the cost of separating the cash business. And we've given guidance for the full year 2021 that'll be 35 million in total, and that it would be significantly lower than that going into 2021 afterwards. After. We also have a number of other one-offs. We have obviously the benefit from the sale of the cash business, and we've got the SFO deferred prosecution agreement, as I mentioned. Those are some of the other main items, but I'll allow you to look through the statutory results at your leisure. I'm now going to move on to slide 22. So clearly, at a time of such market uncertainty, there has been focus on late liquidity and leverage, and we believe we have very strong liquidity. Clearly, the timing of Brink's, the sale to Brink's at the end of February was very fortuitous, but we also have, I'd say, quite a conservative maturity profile for our debt. So you can see along the bottom, we have very small amount maturing this year. Both the bond and the term loan are basically facilities that we have next year, rather than those. The commercial paper, obviously, with the CCFF will have to be refinanced at some point. But we have a lot of liquidity and very small amounts of debt maturing in the short term. The big chunks are, as you can see, the Euro bonds in 2023, 2024 and 2025. So I think that's everything Brilliant. In terms of my presentation.
Thank you, Helen.
I think there may be some questions.
Yes, Helen, thank you very, very much indeed for that. And ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, and we'll also include a link to the video that Helen referred to, and all of that will be available via your Investor Meet Company dashboard. The link will be contained in the email notifying you when that is ready. But before I begin, before I hand back to Helen just to go through the Q&A, I'd like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can understand your views and expectations. Helen, I guess before we come on to the questions, I guess, that have been submitted today, we did have a question that was pre-submitted, and perhaps I could throw that at you. When do you expect to complete the sale of your conventional cash business?
Yes, so 70, I think it's 76% that has completed to date. The other 24%, I think by far the majority of it completes in the next couple of months. I think there's a very small piece that goes into 2021, but majority of the completion and therefore the funds will have been received, I think, by October this year.
That's brilliant. Thank you. Are you happy, Helen, if I just address these questions as in the order that they come in? So
absolutely.
Perfect. Thank you. We've got a question here from Oni. Apologies if that's mispronounced. Is risk consulting and security technology solution all included in technology-enabled revenues?
Yes, it is. So generally, risk consulting is using software to help identify risks within an organization and therefore to come up with a solution that will help mitigate it. One of the, I think, the really good examples that we have is that G4S provides security for the job centres in the UK, the employment exchanges, and so through the data and information that we have collected over years of having that contract, our risk consulting team were able to identify that there are more likely to be incidents on certain days, certain times of those days than at other times. And so you make sure that you have the appropriate level of security. Is basically more on certain days than other days. So that may be one example, or it may be that for a facility needs to make sure that people can come in through a door but not go back through it. So, for example, in an airport, you're allowed to go through a door, but you're not allowed to come back. And so, to make sure that all of the sort of compliance and risk is all collected to provide maybe sort of data, to provide electronic systems that will allow that. So that can be as things such as iris recognition, or just the touch cards that people have to get in and out of buildings. But it would generally be something that is either software or hardware related. And what we used to do was just give, I suppose, the sort of that separate hardware and software piece. So kind of pure hardware and software. And then we thought, well, actually, that's really understating what we do. So our biggest customer by far is Bank of America, and we provide security, all of Bank of America bank branches and their offices around the world. And we know that the reason we have that contract is because of the information and the access control system that we provide them with. We also provide them with a lot of manpower. So majority of the sort of the value of the contract, as it were, would be manpower. But the piece that is on the top in terms of technology is the bit that really differentiates what we're doing and why we have that contract globally rather than in a few countries. They like having a sort of a dashboard of all of that information being provided in one place.
Thank you. And I think perhaps you may have touched on this in the previous response, but Oni asks, and can you further elaborate on what is included, meant by technology-enabled revenues?
Yes. So generally, it would be our manpower plus something else. So risk consulting and security technology tends to be, I'd say, sort of hardware, software. But when you've got, so if you've got a security officer patrolling, doing an incident reporting through their app, that's the kind of the most basic, I'd say, technology enabled. On the other side, we, and this is where I would say, I think we may have to send the video to you. I'm not sure that it is, the link is live, but we'll sort that out. But on the video, we give a number of examples where we manage the security risk operation centers, both for customers, purely for them, and we have some very good examples on the video for BAT in Africa, or we run, I suppose, a facility that multiple customers can use. So it means that in the past, you would have an in-house security team that would be watching, through cameras, CCTV, and incident reporting. What we're doing is basically getting them to outsource that. We would say, you don't need to have your monitoring center at Canary Wharf. You don't. It's much more efficient to have one monitoring center for multiple customers in. I think ours is in Belfast. So it's trying to, again, I suppose, get customers to outsource some of that in-house risk management and security by bringing together all of the information, all the data that we know across, the multiple countries, multiple sectors, and to provide them with better information.
Thank you. Just jumping on to the next question. Thanks for the update. In your security solution businesses, are there any new territories or sectors that you see yourself expanding into?
So thank you. That's a good question. So generally, I'd say in terms of territories, no. I think part of the issue the group has had in the past was that we were in too many countries. We weren't focused enough, and it's something that we look at on a regular basis. There are some obvious gaps in the portfolio. So we're not in, for example, France, Germany, Spain, Portugal, Italy. But every time we review that, we come up with the same decision, which is no, we don't. There's good reasons why we're not, and we're unlikely to go into those businesses, into those countries. And it may be whether it's around how fragmented the market is, or it's around how flexible the labour market is. And so there are real sort of business reasons why we won't necessarily, or why we have exited some of those countries in the past. In terms of sectors, I think that is something that we are getting better at in terms of market segmentation. And I think one of the reasons why our US business is so strong is because they have really focused on customers in key sort of verticals where they see a lot of growth and where we have a lot of expertise, and then have gone very much with a sort of almost a bespoke solution to those customers. And examples like sort of utilities, healthcare, data centers, and again, these would all be on the sort of the US website. That's why they've grown very strongly. They grew at 10% last year, and those are sectors that have been very resilient during the pandemic. In terms of, I suppose, more short term, clearly, we are a big manpower business, and our people that would normally work, say, in events or in the cash business in some cases are therefore being used in other areas. So, we were providing security at the Nightingale hospitals when they were open, and we are now providing manpower for some of the testing sites around the UK. I think that there will be some of this work, is it temporary, or is it, temporary for quite a while? And that's the bit that's hard for us to know. But in the US and in Europe, we have been very much involved in, I suppose, sort of assurance programs about getting people back to work and back into offices. And I think if you're trying to get people in and out of facilities or on transportation and so on, to do that safely and efficiently, but also aware of minimizing sort of touch points, we will be probably playing a role in that. So we have definitely been working with customers to help.
Thank you. Just kind of, there's a couple of more questions if you're happy to proceed.
Yeah, absolutely.
Question here, going back from Oni, going back to the technology related business. What percentage of technology related revenues is recurring, and what percentage is purely installation driven?
Yeah. So on the security side, I think the systems installation piece is still quite small. It's probably less than half, so around that sort of 5-6% for the group as a whole. And clearly, this, that is the piece that we won't really have had in the first half of this year. So I'd say the majority of it is recurring, and the fact that it's growing as a proportion of the group is also obviously offsetting the fact that some of that revenue is installation driven. I think where we, I suppose, have the advantage compared to a pure hardware company is that we can manage and maintain, and that's that's why we would therefore usually win a contract that, yes, it may be doing the risk assessment, designing, installing, but then we're then managing it and maintaining it going forward. So some of the revenue is sort of pass through, I suppose, of installation costs and hardware. But in many cases, we find that particularly the bigger companies, bigger corporates, want to own that themselves. So it's us telling them what to buy and then them installing it, rather than us, I suppose, them having to pay a sort of a markup to us to install the equipment, and we're quite comfortable on that basis that they have the balance sheets to fund the hardware sort of component of the technology piece.
Thank you. And I know you have touched on this next question a couple of times, but can you give some examples of your technology-enabled solutions for clients in your secure solutions business?
Yes, so that's where I would say to look at the video if you have time. I think some of the best examples that we would have would be in areas such as, for example, data centers in the US, by their very nature, are completely unmanned. So all of the monitoring of those facilities is done remotely. And obviously we have monitoring and response capability if there is an issue, but it means that we have, sort of live line of sight and information that we can make sure that the facilities are secure, but there's nobody there on the ground. With the contract that we have in Africa, which is a product called Risk 360, I think that's really interesting because obviously the movement of tobacco products is high risk in probably in any market. These are they're quite high value, very easily saleable, and in Africa are covering quite big distances. And so the operations center for BAT is getting information on traffic, weather, other sort of attacks, and logistics to make sure that those products are moved around safely. The other, I think, areas that we would have examples of would be for financial institutions, say such as Bank of America, where not only we would be providing security to make sure that there are not attacks on bank branches, but it's also around areas around instant reporting. That can be anything from, say, attacks through to something that is more FM related. We can help identify trends. We can help them know how well are their facilities being utilized. If you're tracking people going in and out of a building, do they have excess facilities, or are some areas that are being overused and others underutilized? So we're providing information in a standard form for those customers across hundreds of different sites that can mean that they can manage their portfolio of their property portfolio more securely. We also, I think, some other examples would be around some of the critical national infrastructure that we protect. So some of the work that we're doing for the giant sewer under London, what it's called. But basically, for making sure, if you think about with any sort of big site, or for example, we have Hudson Yards, which is this massive retail and development, so it's commercial, residential, retail in New York. If you've got lots of people going in and out of a building, you've got construction going on, you've got all these different stakeholders. How can you make sure that it's still a pleasant experience for people going in and out of facilities? Another great one that's on the website would be the International Gem Tower in the US, which is basically the equivalent to sort of Hatton Garden that they put into one building, and it's also residential. So you've got one side of the building where people don't want to have to go through iris recognition every time they go to their home, whereas on the other side you've got to make sure that there is a very, very significant amount of security because of the large value of items that are going in and out of that building every day. So sorry, I'll stop there.
No problem. And just to say, Helen, that the video is now being downloaded, and there'll be a link included to all the investors, so they can watch that when the Q&A and the recording of this presentation is made available. Okay. We've got a couple more questions, if I may. Do you aim to grow organically predominantly, or are you looking at growth through acquisition?
So I think it's primarily going to be organic. The areas where we may look for bolt-on acquisitions would be in areas like monitoring and response. So if you think, if you're covering a certain country or part of the country, and you have the ability to add on an additional sort of clients, there's obviously very good operational leverage benefits. So the most of the small acquisitions that we've made in the last couple of years have been in that sort of monitoring and response space. That's sort of, that's the patrol vehicles and people that respond to that. One of the other areas that I'm asked on, and I probably should have also covered it in Abigail's previous question, which was around services, that we're often asked about cyber security, and clearly when we're doing a big sort of risk assessment for a customer, that is usually one of the key areas of of concern and responsibility for the head of risk or head of security for different institutions. We do have some in-house capability for cyber, but generally what we will do is we will partner with experts in that area, and that's where I'd say generally if it's something that we don't do and we think well that could be useful for that customer, then we'll probably partner or we'll acquire. So whether it's drones or whatever the latest thing is, we generally feel that we probably don't need to buy those businesses. We can just purchase, be a customer for their services. I think generally, we've seen that the group was so acquisitive and really sort of destroyed quite a lot of value. And we have the opposite sort of situation today, where we have lots of great products and services for customers in some countries that we really need to leverage in other countries. So that's where I'd say the investment is more in-house, ensure that we've got the right salespeople and business development people to say, well, look what the US is doing. That's really interesting. I could use that for my customer over here, rather than historically where they might have thought, well, we don't need to do it the way that they do it. We're going to do it our own way. And then you have multiple different ways of doing a very similar thing, and that's where to try and centralize our technology strategy is also sort of a part of, again, being more focused in what we do.
Sure. Just looking at the question about, do you look at targeting additional countries for operation? I guess we've probably touched on that already in the previous question, unless there's anything you add.
Yeah.
So if I move on to the next question, do you separate the risk consulting and security technology component of your offering in all contracts? Does the client get a separate price for this part? And of course, we can always come back to these questions if you
I mean, I think
prefer.
generally it is. It's going to depend on if it's I suppose what the customer is asking for. So if they want us to do a risk assessment and then we come up with there would be definitely a cost of that, and then if it's part of the solution, which is technology and manpower, then yes, it might be that it's more, I suppose, as the solution that we are providing, rather than saying than completely sort of separating each part out. But there would be other, I'm sure, sort of RFP sort of more sort of internet bidding where you are pricing separately. But generally, I'd say for an integrated offering, it's probably that you're not really seeing a separate price for it.
Thank you. Obviously, Oni, we've mentioned about the video that will be sent to you separately.
Great.
We've got two final questions, if we may, and then perhaps I will ask you to maybe wrap up, and then I'll divert to investors for feedback. Are there specific parts of the offering that make G4S products more captive towards its clients, such as software? What percentage of contracts have service technology components?
A very good question. So definitely, we know that the software that we have within our access control systems, within incident reporting, with Risk 360, Symmetry, these are some of the sort of brand names, as it were, that so you could see more information on the website. So this is proprietary G4S software, and that we are providing to customers, and is seen, the Symmetry sort of access control system is used in the Pentagon. It's used by the US Navy, so I mean it's seen as really sort of world class in terms of it being an access control system. So yes, I think that is definitely, as I say, why we have customers like Bank of America, and why we have a very good contract retention overall, is more than 90% of revenues. The amount of contracts that have that software technology component, I mean, that's where I would say it's the 49% of contracts that are technology enabled. So it might be that 10% is technology, 90% is manpower for that contract, or it could be the other way round. But what is providing the differentiation is the technology and the software. And so you could say, well, the 49% is kind of overstating it because it's taking the whole value of the contract. But if we are trying to separate it out, sometimes it can be quite hard to do, and we have tens of thousands of contracts, so it's not a KPI that we are really tracking to that level of detail. But I would say as well, to include the whole lot is also not necessarily going to help us in the medium term, because obviously if we move the proportion of the contract from a high proportion of manpower to low proportion of manpower, it wouldn't move that percentage. It's still because we've taken the whole piece. But I suppose what that 49% is saying with technology enabled is that technology is differentiating it in some way or another than purely being manned security.
Thank you. And I'm somewhat relieved, I guess you probably need a drink after this, but a final question here.
Yeah, I'm glad I'm not on camera.
Is the fastest growing technology solutions business equally distributed across geographies, or is it heavily weighted towards Europe and North America?
Oh yeah, that's a really good question. So it's probably something I should have covered. So today, we have, I'd say, real pockets of expertise in terms of technology, and it's both in terms of where we have the technology expertise and products, but it's also our approach to market. We're very strong in North America, very strong in places like Denmark and South Africa, and increasingly here in the UK. But there is, I suppose, an opportunity still in some other parts of Northern Europe where we believe that we should be having a more technology-enabled and less manpower. And I think one of the things from COVID has also demonstrated that we were very heavily weighted to areas like aviation, ports, and that we probably need to think about our customer sort of sectors and segmentation, as well as the technology solution for that business. I think the Denmark business has had an incredible transformation from moving basically from a home alarm business. It was 90% home alarm to now 70% commercial technology enabled, and so we're using really the lessons learnt and how they did that model, which was called the G4S Academy, and we're using that model now across Northwest Europe and the team that were very successful in Denmark are driving that. In other markets, in our emerging markets, I say we've got pockets of expertise, such as in South Africa, because of the particular, I suppose, demand from customers like BAT. But one of the, I suppose, advantages of technology is that it's very attractive where you have high wages. So, there is basically a wage kind of technology arbitrage in markets where technology has become cheaper, is more reliable, and you've had, quite high wage inflation. And so that's why I think it's also been very successful in North America, in Denmark, and why there is opportunities in other parts of Europe. In some countries such as India, other parts of Asia, LATAM, the cost of manned security is just so much lower because wages and salaries are so much lower. There isn't, I suppose, the same arbitrage. But what you have is that customers are, I think, increasingly wanting technology as part of the offering to provide, as I say, sort of compliance and assurance. And so we do think that we're very well positioned there, but we are partly relying really on the customers. So again, another good example on the video, this famous visit video is in Singapore, where the Singaporean government, their whole strategy was about introducing more technology within the services that they tender for. And so we won a contract providing security for hundreds of schools in Singapore because of the technology component. So that's one of the examples that we give. So sometimes it's also trying to take your customer on that journey, but I think also in markets like North America, we've seen a change in our client base. So previously, chief security officers would have come from, say, the police or military type background, and increasingly now they are coming from more of a sort of a risk background and cyber, and sort of therefore much more comfortable with technology. And I think that's also driving that move to more technology in those markets.
Brilliant. Thank you very much. I think you've taken every question that has been submitted, so thank you very much for that, and thank you very much for giving investors the chance to be updated. As I say, from management director, it's fantastic. Thank you very much. Helen, perhaps you would just like to wrap up, and then what I'll do is I'll redirect investors to give feedback and then end the session.
Yeah, so thank you very much. Thank you very much, everybody, for your time. So apologies that I was a bit late joining, and very much would welcome your feedback. It's the first time that we have used Investor Meet, and very much like the opportunity to speak to you today. So thank you very much. Thank you.
Thank you very much, Helen. Lovely. Can I ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear. If you access via the link sent you by email, you'll be asked to log in to provide feedback. So on behalf of G4S and Investor Meet Company, I'd like to thank you for attending today's meeting. As I say, we will forward the copy of the video to you in the email, notifying you when it's ready. Thank you very much indeed.